Hello, welcome to ACC F3 Financial Accounting. Today we will be discussing about accounting cycle and double entry bookkeeping. Firstly, let's begin with the accounting cycle. So the accounting cycle begins with the source documents. With regards to the source documents, that means we're talking about the invoices, the sales orders, purchase orders, and so on. This is because when it comes to financial accounting, everything always has to begin from somewhere, and financial accounting is about recording and summarizing and posting financial records, so we always have to start from the source documents. Next, we continue to the books of prime entry. Now, about the books of prime entry, there are 7 types of books, which we will be getting into in the next slide. Continuing from the books of prime entry, after the source documents have been sorted and posted into their respective books according to the basis or the nature of the accounting transaction, the books will then further be posted into ledgers. Ledgers are also known as T accounts, and there are 2 types. After having posting all of the information from the books of prime entry in the ledgers, we're then going to summarize them into the trial balance. Now, the difference between the books of prime entry and the ledgers and the trial balance is that the ledgers require us to consider the double entries of each of these transactions. And in order to test whether our double entries are correct and to see if the debits and credits do indeed balance, we use the trial balance and also to test if they do balance. Lastly, all of the information, after knowing that everything has balanced, we post them into the financial statements, in which there are 5 of them, which we will also be getting into in the next few slides. So let's begin from the source documents first. Now, I won't be listing all of the source documents as there are plenty of them. However, I will be highlighting on a few that tend to get mixed up with. However, in practice, it might be quite distinguishable. So firstly, we will discuss the credit note. Now, what is a credit note exactly? This is where a supplier is going to send a credit note to the customer. Now, why will they be sending this to the customer? Well, some circumstances arise in which a customer decides to return the goods back to the supplier. Or it could also be because of accidentally overpaying the supplier. So the customer will be sending the goods back, and in return, the supplier is going to give a credit note. So in otherwise, you could think of it as a negative invoice, because normally an invoice is going to request for payment from the customer, but a credit note is there to reduce the customer's balance instead, as proof that because the customer has returned goods to us, we're going to reduce the balance on their behalf. Next, we will discuss the debit note, which is similar to the credit note and is used along with the credit note as well. Now, what happens in this case is that the customer is the one who is going to be sending it to the supplier. In the case where the customer is requesting the supplier to reduce their balance, that is when the customer is required to send the debit note to them. So they're going to come up to them and say, hey, I want to return my goods that I bought from you. Can you reduce my balance? Because obviously I'm not going to pay for those goods. So they're going to send a debit note as a formal request for the credit note. So in return, what the supplier is later on going to give to the customer is the credit note, which acts as a proof that, yes, I have finally deducted or reversed your balance. Okay, one more source document that I want to discuss is something called the remittance advice. So what is a remittance advice? It is a sort of document that is sent by the customer to the supplier, but its function is not like a debit note. Instead, a customer sends this along with their payment. Now, at certain times where a customer is billed more than once and none of these bills are paid immediately, the customer may then decide to pay off all of these invoices at once. So the remittance details which invoices are being paid off. So let's say I have been billed for $100 and I have received 5 of these bills. So in total, I have to pay $500. So maybe by the end of the month, I decide to cover off all of these invoices and I pay directly $500. So I'm going to have to give a sort of notice to the supplier. Which invoices am I covering with this $500, to be specific? Okay, now continuing to the next part of the accounting cycle. We began with the source documents and now we're moving to the books of prime entry. Earlier I have mentioned that there are 7 types of books of prime entry. First is the sales day book. Now the sales day book is connected with your trade receivables control account, which we will be discussing in a while, and it's basically for recording credit sales only. Please remember that in cases where there are cash transaction and cash sales, that will be recorded in a separate book called the cash book. So because of sales, these credit sales in particular, instead of getting cash, we're going to be getting trade receivables. So it's very important that we properly document our sales invoices and to whom we have made a credit sale to make sure that our trade receivables balances are also correct. Second, we have the purchase day book, which is quite similar to the sales day book. The purchase day book is for recording credit purchases. So similar to a sales day book, a purchase day book is going to be needed to make sure that our trade payables account is properly kept and is matching with our purchases day book purchases figure or total purchases figure. I will explain it in further detail in the next few slides. Now, because we have a sales day book, of course, there are circumstances where a customer would want to return the goods to us even though they haven't paid for it yet. So that's why we need to maintain a sales returns day book as well, which is for recording credit notes that we have made. So similar to the sales returns day book, we would also have to maintain a purchases returns day book. Now, if a sales returns day book is to record goods that have come back to us, then the purchases returns day book is going to be used to record credit notes that we have received from the suppliers because we're the ones who are going to be returning the goods to them. So as a result, our balance is going to be reduced by the trade payable and we're going to receive a credit note as proof. Now, for terminology's sake, I'll let you know that sales returns is also called returns inwards and purchase returns is called returns outwards. Sometimes it can be listed differently, so make sure that you get the understanding that the meaning is the same. Fifth, we have the cash book, which I mentioned before is only for cash transactions. So whenever you have a sales or purchase made in cash, then it's going to be recorded in the cash book. Sixth, we have the petty cash book. And please make sure that you do not mix this up with the cash book because a petty cash book is for small cash transactions only. Whereas a cash book would be used for, let's say, a sales of $1,000 or $1 million, a petty cash book would be merely for transactions up until $200. Now, in certain organizations, they maintain a petty cash system, or what we call the impressed system. And this impressed system is going to be used along with the petty cash book for documentation purposes. Let me explain to you what the impressed system is about. Let's say, for example, I maintain in my company a petty cash amount of $200 every single day. So that $200 is my impressed amount. And every time I spend some certain amount out of that $200, I'm going to have to reimburse that. So for example, if I spend $50 of expenditure on stationery, then I'm going to have to reimburse that $50 to get back to the original $200 impressed amount. Lastly, we maintain a journal. Now the journal is a unique kind of book of prime entry as it is used to record transactions that do not fall into other 6 books. So they're simply for other transactions that do not meet the other 6 books. And in cases where there are errors in the debit and credits, we can correct these errors by the use of double entries. So we can input the journal entries or the double entries into the journal to make sure that we have corrected these errors and we have documented them properly. Alright, so we have come to the end of the book subprime entry. Next, we are going to discuss about ledgers. So as I mentioned earlier, we have 2 types of ledgers. First is the nominal or general ledger. As the name implies, general ledger means that it is used to maintain T accounts for general items. So it records accounts for basically anything that is impersonal. So examples could be assets, liabilities, income, expenses, and so on. So the highlight of the general ledger is that it records impersonal items. So that means it does not relate to a particular person. So for example, would be a trade receivables control account and a trade payables control account. Now, why they are called control accounts and what makes them different from a usual trade receivables account is that these accounts are used to maintain total figures only. So let's say a trade receivables control account. Inside that, I will be maintaining the total figures of credit sales, the total figures of discounts I have given to all of my trade receivables, all of the sales returns from my trade receivables, all of the cash that I've received from my trade receivables, and so on. Same applies to the trade payables control account. Now, as I've mentioned, this relates to an impersonal account. So the trade receivables control account does not maintain the individual customers that the company has. Instead, they just take the total figure that they have earned or they have generated from the trade receivables. However, there are other examples as well that go into the general ledger, which could be the plant and machinery account, which would record the movements of your plant and machinery, or an inventory account, and so on, or a cash account. Second, we have a receivables and payables ledger. Now, a receivables ledger and a payables ledger individually record personal accounts. So if we were to say we maintain a receivables ledger, inside that receivables ledger would be the individual trade receivables accounts that of all of the customers that we have. So an example would look like this. As a T account, now another thing about the receivables and payables ledger is that they're also called a list of balances. List of balances literally means that the receivables ledger, for example, maintains a list of all of the individual customers that the company has. So an example would be that I have 3 customers or 3 trade receivables, Mr. A, Mr. B, and Mr. C, and each of them would have their own respective opening balances. So balance brought down. And they would also have cash figures, let's say. So whatever transactions that have occurred between myself and these customers would have to be recorded in their own respective accounts. So let's say customer A has paid me a certain amount of cash, customer B has paid me a certain amount of cash, and so has customer C. Let's say 100 and then 200 and then another $100. So basically in total I should be getting a $400 amount of cash from my 3 trade receivables. So under the trade receivables control account, I'm going to post the total cash figure of $400 instead of showing the individual accounts. So that's why we need to maintain both in order to be able to check whether they balance or not. So the totals of the customers A, B, and C would simply be posted into the trade receivables control account. Alright, so we have completed the different kinds of ledgers. Now let's continue on to the trial balance. So what is the trial balance for? As you can see from the ledgers, we needed to consider the debits and credits of each account and making sure that we post the debit and credits properly. So in order for us to make sure whether or not we have done it correctly, we need to post a trial balance. So a regular trial balance will look something like this, in which we separate the debits and credits, and we take the different types of accounts that our company may have. So for example, a company would have a sales account, a purchases account, a cash account, capital account, inventory account, and so on. The list could go on. So, for example, when we're talking about trade receivables, they are generally a debit entry because they are an asset. And therefore, as you can see, that when we complete their account, we're going to have to post a closing balance. As I've written in the previous slide, I began with an opening balance. So after transactions have happened throughout the month, I'm going to close the figure and then post it as a closing balance. So each individual figure will be then posted, but we only take the closing figures. So we post them according to their proper debit and credit entry. So for example, if on the debit side I have 100,000, but on the credit side I have 90,000, that means my trial balance does not balance and it does not add up. So temporarily, I'm going to have to open a suspense account. This suspense account is meant to be put on the side that is much lower in order to balance it with the other side. So in this case, I'm going to put 10,000 on the credit side to make it balance with the debit side of 100,000. But the suspense account is only temporary. So we're going to have to figure out where did we make any errors. So once we have found our errors and corrected them, the suspense account should then be put into zero and it should be removed. So that entire 10,000 will no longer be there and should no longer be there by the end of the month. So in summary, the trial balance is used to check if the debit and credits are balanced. And in any case that we need to open a suspense account, it may be opened, but it is only used temporarily. However, in practice, it may be quite difficult to eliminate the suspense account. Finally, we have reached to the last stage of the accounting cycle, which is financial statements. Now, there are 5 financial statements that we use, and we are going to be presenting them according to IAS 1 presentation of financial statements. Now, the first financial statement I will be getting into is the statement of profit or loss. Now, there is a particular format that we would normally follow. So when beginning a statement, normally we would need to post our company name first. So for example, ABC Co. And then list down statement of profit or loss and other comprehensive income as at year end, whatever the financial year end is. However, please do not abbreviate the words. I'm simply abbreviating because of the lack of space. Once you have gotten your heading properly, we begin putting down the items. So first, let's begin with the revenue figure. And from there, you're going to deduct your cost of sales figure. Cost of sales or cost of goods sold are also the same thing. So once you have deducted that, you're going to get your gross profit. Now, in the case where the company receives other income, such as rental income, you're also allowed to put that directly under the gross profit and name it other income. You can also put in subheadings such as rental income or investment income to reflect where you've gotten the income from. Next, we're going to deduct other expenses. First would be the distribution costs. And when I put in brackets, I'm implying that it means a negative or a minus figure. Then we have to also deduct the administration expenses. And in other cases where there are expenses that do not fit into either two, we call them other expenses. Now, all three of those expenses, when combined, we call them operating expenses. And once you have finally deducted your operating expenses, you will reach to a figure that is commonly known as profit before interest and tax, but in this case, it should be called operating profit. Once you have reached your operating profit, you will then need to deduct other kinds of costs, particularly your interest charges and your taxation. Interest charges is also known as finance costs. In certain circumstances, it would be called cost of capital as well. So please note that all three simply mean interest. Once you have deducted your finance costs from your operating profit, you will then reach to a figure that is profit before tax. Once you have reached that, next, income tax expense will be deducted to reach to your profit for the year figure. Now, below the profit for the year figure, we would have additional items known as your other comprehensive income. So in other comprehensive income, we will include items that do not directly relate to the profits earned from trading. However, because this is only F3, we will only be including revaluation gains or losses under the other comprehensive income. In reality, there are many more items that would be included under other comprehensive income, such as foreign exchange gains or losses. Once you have added your other comprehensive income to your profit for the year figure, you should then get your total comprehensive income figure. Next, let's begin discussing about the statement of financial position. Now, in here, I've listed an image of how a statement of financial position would generally look like. However, the contents may vary from company to company. But what is generally included would be a comparative in which a previous year financial position is included to compare with this year's financial position. Other contents that should be in there would be assets, equity and liabilities. Assets are then split into non-current and current. Non-current is long-term and current is short-term. I will be discussing these in more detail in a while. Equity and liabilities is split into equity and liabilities. And the liabilities is also split between non-current and current, similar to how the assets is split. And once you have added all of these together, the total assets should balance with your total equities and liabilities. In here, I have included a statement of changes in equity in which we show the movements of capital throughout the year. Now, inside the statement of changes in equity, we will show whatever the contents that the company has. So in this case, they would have share capital, retained earnings as at 31st December 2002. So the total figure in the statement of changes in equity would then be posted to the SOFP. The total figure for the share capital, however, at the closing balance, would then be posted into the SOFP, but only the closing balance. Same goes for the other balances such as retained earnings and other components of equity. So the opening balance will be how much it was last year, and other details would be what kinds of transactions have happened to equity throughout the financial year. So basically what the SOFP displays regarding to equity would simply be the year-end figure only, whereas the statement of changes in equity is going to show the entire movement from beginning to the end. Now, so far we have only listed 3 financial statements. There are also 2 more. Fourth would be the statement of cash flows. Now, I will not be displaying the statement of cash flows in this chapter, as it would be further discussed in a different chapter. However, it basically is a statement displaying the movements of cash that has been generated or used in 3 separate activities known as operating, financing, and investing activities. Fifth is the disclosure notes to the financial statements. Now, disclosure notes is mainly for additional information to the information that is already provided by the other financial statements. It provides additional details, such as if we were talking about property, plant, and equipment, for example, it would include information such as how much was the equipment that was bought during the year, how much was disposed, how much was depreciation, and so on, so that the final figure will be posted in the SOFP under non-current assets. More detail as to how the figure has been arrived will be shown in disclosure notes. Other kinds of information could be in cases where the company is facing a legal claim or a lawsuit, and they would have to provide some sort of provision for it. So they're going to have to give a kind of disclosure as to why they have provided provision or why they have only put a contingent liability. Other information could be the financial risk or investment ratios that the company has used in deriving their figures. Next, we will be discussing about the accounting equation. The accounting equations is simply assets is equal to liabilities plus capital. Now, terminology-wise, capital is also known as net assets or equity. Assets is split into two, non-current and current. What differentiates between the two is the duration of how long the company is able to own this asset. So if we're talking about non-current or long-term assets, we're referring to more than 1 year. However, when it comes to current assets, we're talking about less than 1 year. Liabilities is also split in a similar manner between non-current and current. So again, it also means more than 1 year, and current means less than 1 year. So let's talk about examples. An example of a non-current asset would be something that the company can own or can control for more than a year. So common examples could be the property, plant, and equipment, buildings that the company has bought for itself, not for trading purposes, motor vehicles also used for the business, and etc. It also could include land, for example. Now, a current asset would commonly be inventory. This is used for trading and is commonly bought and sold on a daily basis. Trade receivables is also a current asset because the company technically owns them until the trade receivable covers off their debt. Cash is also another example. When it comes to non-current liabilities, we commonly think of bank loans, as it would take a number of years for a company to repay their debt. Whereas for current liabilities, we're talking about trade payables or suppliers and overdrafts. Overdrafts are circumstances where you need to withdraw more money than how much your bank balance currently has. So technically you're borrowing from the bank, or you could also think of it as a negative bank balance. Now, regarding to capital, there are 4 components which would influence the capital of a company. 1 is income, 2nd is expenses, 3rd is drawings, and 4th is profit. Now, basically, capital is mainly influenced through profits, and what affects profits is the income and expenses that the company will face throughout the financial year. Drawings, on the other hand, mean that the owner of the company has withdrawn something that belongs to the company, but is going to be using it for personal use. So, if we were to receive more income, such as rental income, we're going to list that in our statement of profit or loss, and it will increase our profits. When we retain our profits after the financial year and bring it back to capital, that means our capital will then increase. Expenses would reduce that, and drawings would also reduce the capital that we have. Profits, the more profits that we retain or bring back into the company after paying dividends or not, which is also known as retained earnings, it would then cause the capital to increase. So for example, if a sole trader decides to withdraw inventory from the company, the double entry would be that Well, drawings is similar to like an expense. It reduces capital in a certain way, so it's going to be a debit figure. What would be reduced as well is the purchases in the company. So if we're talking about double entries, a drawing would be debit drawings account and credit purchases. So if we're talking about double entries, assets are naturally a debit entry, whereas liabilities and capital are credit. So whenever an asset increases, it should be a debit figure. So let's say I receive cash from my trade receivables. That means my cash is going up. So if cash is going up, we're going to debit the cash account. Whereas if assets go down, it will be a credit figure. So if I receive cash and my trade receivables has paid me off for that, that means I will reduce my trade receivables. Now trade receivables is also an asset, so I would credit my trade receivables account. On the other hand, for liabilities and capital, if they go up, it would be a credit figure. So in this case, if I were to take a bank loan, that means I would have to increase my liabilities. So I would credit my bank loan account to reflect that I now have a liability or an increased liability. Whereas if I repay off my loan, that means my liability will go down and it would be a debit to my bank loan account. Similar to expenses and drawings, since they reduce our profits and reduce our capital, then it would be a debit figure. So if I had a telephone expense, I would say debit the telephone account. So if a sole trader were to draw from the company, then it would be a debit drawings and credit purchases figure, because drawings reduce our capital, so it's a debit figure, right? And purchases, which is like an expense, is now being reduced because inventory is being taken out of there. So if a purchase, which is naturally a debit figure, is being reduced, it would simply be the opposite and therefore be a credit to the account. So income should be a credit because it increases capital. So if income is being reduced, then it would be debited income account. Also in detail, income is a credit figure, expense is a debit figure, drawings is naturally a debit, and profits are naturally a credit figure. Now I have taken these definitions from the BPP study text for F3. An asset is something valuable which a business owns or can use. So an asset does not mean that the company has to buy it. They can also lease it and yet still have some sort of control over it, and is still classified as their asset. An asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Meaning that when the company uses this machinery or uses this building, it's supposed to help them generate some sort of income in the future. And past events means that they have done some sort of transaction in the past to be able to acquire this asset that they are now controlling. Next, let's get into the definitions of liability and capital. Now, I've also taken these from the BPP study text. Okay, firstly, a liability is something which is owed to somebody else. So opposite to an asset, we are owing this item to a person, not owning it. They represent the debts of a business. So they're a present obligation arising from past events and settlement of which is expected to result in an outflow from the entity. Meaning that when a company has a liability, they're expecting that they're going to have to spend money or spend some sort of other asset in order to pay off that liability. But currently they do owe the liability to someone, and once it's paid off because of an outflow, then the obligation would then no longer exist. Now, when talking about capital, capital means it is the amounts invested in a business by the owners. And so the business owns to the owner. This is a special kind of liability called capital. In a limited liability company, capital usually takes form of shares. Share capital is also known as equity. So equity is the residual interest in the assets after deducting all of its liabilities. So when we refer to the accounting equation, which was assets is equal to liabilities plus capital, then if you move the liabilities and deduct that from the assets, you will get capital. Capital also means net assets or equity. So I shall list them down here. Now let's begin on discussing the business equation. The business equation is simply a form to reflect on how we derive our capital figure from the accounting equation. So remember, a capital is made up of 4 components: income, expenses, drawings, and profits. And so capital can also be broken down into a different kind of way using the business equation. So the closing capital figure, closing net assets or closing equity, also known as the final capital figure at the end of the financial year, can be found by taking your opening capital or your opening balance, adding with the capital that was introduced during the year. And otherwise, you could also think of injection of capital, plus profits earned during the year, minus the drawings that were made by the owner of the company. So you can see that there's a movement. Once you have added all of these, you will get the closing balance of capital at the end of the year. So you can also use it to find profit. Profit is taken by taking the closing capital and deducting the opening capital from that. Add back your drawings and minus the capital that was introduced during the year. So you want to add back all of the figures that were done by the sole trader, which is capital introduced in drawings. So you want to take that out and remove that to purely reflect on how the capital has moved during the year, just because of profit. Now let's begin doing some questions. So let's read. The profit made by a business in 2007 was $35,400. The proprietor injected new capital of $10,200 during the year. So note that it says the profit was $35,400 and new capital, which means introduced capital or capital introduced, was $10,200 during that year, and withdrew a monthly salary of $500. Now, when it says withdrew, it signals drawings, and it says monthly. So what it means by monthly is that they took this amount every month during the year. If net assets at the end of 2007, if the net assets at the end of 2007 were $95,100, so if it says at the end, that means closing capital. What was the proprietor's capital at the beginning of the year? So they're asking for the opening capital figure. So we're going to have to use the business equation over here. So let's find the difference throughout the year first. The difference and movements of capital caused by profit, capital introduced, and drawings. So $35,400 minus $500 times 12 to reflect a year full of drawings. So we take the profit, deduct drawings, and add the capital that was introduced of $10,200 to get the movement throughout the year, which should equal to $39,600. So our capital from the beginning until the end has changed because of this. So let's just work backwards then. If we know at the end of the year we got $95,100, all we need to do is minus the $39,600 to get back to our opening figure, which should be $55,500. Let's look at the next question. Journal entry. So we have to make a journal entry. A sole trader took some goods costing $800 from inventory for his own use. The normal selling price is $1,600. So note that there is a difference between the cost and the selling price. Okay, so firstly, we need to identify that this is a drawing because it says he took some goods for his own use. And because the cost is $800 and the selling price is $1,600, we need to understand which figure should be used. And drawings is an expense, so it will be a debit figure because it's reducing our capital. So we're going to debit the drawings account. And what are we going to credit? Well, it does say inventory, and inventory is related to the purchases figure. So we're going to have to reduce our purchases account. Now, which figure are we going to use, 800 or 1,600? Well, the sole trader is not selling the goods to himself. If he were, he would have recorded it at 1,600. But instead, it costs. So this inventory was initially bought by the company at $800. So they still have the value of $800. Therefore, when you're going to record drawings, you have to record at the cost figure, not at the selling price. If you were to record at selling price, this would not be a drawing, it should be a sales. So you're going to put 800 for both. Let's look at this next question. There is a sale on credit for $150 to F. Roget. Return of goods from B. Blendig was originally sold for $300 in cash to B. Blendig. They're asking what are the correct ledger entries to record these transactions. So sale on credit. What it means by credit is that we're going to receive a trade receivable. We are not getting cash. So we are now having more trade receivables than before, and a trade receivable is an asset. So when assets go up, that means it is a debit entry. So we should debit the trade receivable account to show that now we have more trade receivables that owe us money. And note that I am not using F. Roget's name because the individual trade receivable is normally not included in the double entry system, but we use trade receivables instead. Now, what will be credited? Well, a sale, think about a sale. We need to record the trade receivable and we need to record the sale as well. And sale represents income to the company. So when there's more income, there's more capital indirectly through profits. So in that way, sales are always going to be a credit, unless if it's a reduction, such as a sales return. So we're going to credit the sales account, and the figure would be 150 for both. Now 2, return of goods. So if it was a return of goods originally sold, that means that it was a sale before, but now the person is returning the goods to us. So it's a sales return. So it's a reduction in the sales. So when we reduce it, we cannot just simply debit sales. We need to say debit sales returns, because now it's the opposite of a sale and it's in cash. So if he's returning the goods, of course we should also return the cash, because he will no longer have to be owning these goods and we don't have the right to have his cash anymore. So when cash is going down, and cash is normally an asset, if assets go down, we will need to credit that account of T. Talon. So credit cash by $300. Okay, let's take a look at this question. In here, it is a trade payables account at 30 September 2001. Okay, so on one side, it would be debits. And note how it says balance BD, meaning balance brought down. We also have cash and so on. So let me label. One side is debit, one side is credit. Okay, so the balance brought down is going to show us how much is the figure of the trade payables at the beginning of the year. In this case, it's $14,000. So we owed trade payables $14,000 at the beginning of the year. So trade payables is normally a liability and is a credit figure. That's why the balance brought down is on the credit side. Now, why is cash on the debit side, if you're wondering? So trade payables they're a liability. We owe them money, and so they are naturally a credit. Now, anything that would reduce our trade payables would be a debit to them, okay? So in this case, where we have cash of $21,600, that means during the year, we have paid our trade receivables $21,600. So let's think about the double entry. We would be debiting trade payables and credit the cash account. But why is the cash account on the debit side here? Well, when we're writing the double entry like that, we should look at the account that we're working under. If it says credit cash, that means the cash account is being credited. But look at here, we're talking about the trade payables account, not the cash account. And so if the trade payable account is the one being debited, we're going to debit it and record cash at bank to reflect that our trade payables has gone down because we have paid cash. And then below that, we have the balance carried down, meaning the closing balance. And they're asking for the trial balance figure at 1st October 2000. So the difference between balance brought down and balance carried down is simply which one is opening, which one is closing. Now they're asking for 1st October, but we're given 30 September 2001. So we need to identify the dates with the figure. Okay, so let's see, 11,900 is for the closing balance. Closing balance is 30 September 2001, whereas they're asking for 1st October 2000. So that means it's the beginning of the year, right? So if they're asking for the beginning of the year, the answer should be 14,000, because that is the figure of trade payables at the opening. If they had asked for 30 September 2001, we would have given the 11,900 figure. And even though at the moment the closing balance is on the debit side, when the figure opens on 1st October 2001, it's going to move to the credit side of the account. So currently, it's simply shown on the debit side to balance both sides and to show that it's going to become a balance BD on 1st October 2001 on the credit side. Alright, now let's do some practice with the sales day books and purchases day book. So the question here says, what is the total of the sales day book? And what is the total of the purchases day book? So remember that these are used only to record credit transactions. So the sales day book is going to use for credit sales only. And purchases day book is for credit purchases only. So let's try to identify out of all of these transactions. May 1st sold $160 of goods to P. Dixon on credit. Write down 160. On 1st May 2009, Marshall's cash book showed a cash balance of $224 and an overdraft of $336. During the week ended 6 May, the following transactions took place. Okay, so all of these transactions have happened throughout just 1 week. May 1st, he also withdrew $50 of cash from the bank for business use. So as you can see, it says cash. So anything relating to cash, whether it's a check or a cash transaction, goes to the cash book. May 2 purchased goods from A. Clark on credit on $380 less 15% trade discount. Okay, so this is obviously a purchase on credit because it says it was on credit. And the figure, however, would be after deducting that trade discount, because we're not paying at $380 anymore, and we're going to owe him net figure, which would be $380 minus the 15% discount, which would be $323. Repaid a debt of $120 owing to R. Hill taking advantage of a 10% cash discount. The payment was by check. So by check and repaying a debt, that means a cash book would be relevant. Because what it basically means was that sold $45 of goods for cash. It's also cash book. Sold $80 of goods on credit, offering a 12.5% discount if payment was made within 7 days. So we're only going to deduct that figure from the $80 if there is proof, but so far we don't see anything that he has paid us. So we're still going to have to record the sale at its original figure of $80. If you look at May 4, it says we paid telephone bill, and then there's a receive a check, and so on, but there's no proof that they have paid us yet, so they can't get the discount either. So we're just going to add the original figure to the sales day book of $80. Paid a telephone bill of $210 by check. So cash book again, purchased for $100 on credit. So purchased on credit should signal the purchase day book because it's a credit purchase. So we're going to directly write down $400. Received a check from H. Larkin for $180. Larkin has taken advantage of a $20 cash discount offered to him. So, firstly, don't get too confused with the cash discount. It's simply explaining that he has received a discount and now he's paying the net amount of $180. So, again, check means cash book, and we're just going to record at $180. Sold 304 of goods to M. Donald on credit. So it says sold on credit. So we're going to have to include that in our sales day book. So add $304. Purchased $135 of goods from Honor Co. by check. So again, if it says check, it should be the cash book. Purchased $100 of goods on credit from G. Perkins. And this should be our final credit purchase. And afterwards, you should total up all of these invoices to get to our total figure. So the total sales day book is 544, whereas the total purchases day book is 823. Bert has extracted the following list of balances from his general ledger at 31st October 2005, and they're asking total of debit balances in Bert's trial balance. So we're going to just have to select which one is a debit, but of course it should balance either way if you do it properly. So let's figure out which one of these are debit balances only. So sales, as we know, are increasing income, increasing profits, so they're a credit. Opening inventory is an asset, even though it says opening, but still it's a current asset, and so it's naturally a debit entry then. Then we have purchases, which would also be classified as an expense. So I'm going to list these down first. Sales should go on the credit side. Opening inventory would be on the debit side. And purchases as expenses, or the opposite of sales, would therefore be a debit entry. Expenses are debits. So I'm going to list down expenses. $34,835. Non-current assets are obviously assets, so they're also going to be a debit figure. So I'm going to list non-current assets, $63,960. Receivables are also debits because we own them. So receivables are $31,746. Payables are your liabilities, your suppliers, so they will be a credit figure. They should be on the opposite side, $13,864. Cash at bank, you own cash, so it's a current asset, so it's going to be a debit figure. And capital is capital, so it's credit. So 1,783 and 12,525. So when you total all of these, they should be able to balance. So by right, the debit should equal to 284,931, whereas credits would also be 284,931. If you are able, you can calculate on your own, but I'm going to also calculate to confirm the figure. So 9649 plus 142,958, 34,835 plus 63,960 plus 31,746 plus 1,783. So we get it 284,931. 13,531. And if we add the credit side, also 13,864 and 12,525, we should also get the same figure. So that confirms it, our trial balance balances, and we know the debits are as the follows. So thank you for watching, and I hope this has been beneficial to you.